tech stocks crashing then exploding back up? Here's how smart investors win in volatile markets. Because missing just a few of the best market days can destroy your long-term returns.
Okay, so if you've been watching the tech and semiconductor markets lately, you've probably felt like you need a neck brace, right? One minute, everything's plummeting, and the next, it's just rocketing back up. So the big question is, how do you navigate this kind of whiplash and actually stay invested for the long haul? Well, let's get into it.
Be honest, when you saw your portfolio dropping day after day, that big red sell button started looking pretty tempting, didn't it? That feeling is completely normal. The urge to just get out and stop the bleeding can be totally overwhelming. I get it. But was it the right move?
To really understand why, we've got to look at the signature move of today's markets, what we call the V-shaped recovery. You've probably seen it. It's a pattern we see time and time again, especially in tech. It's this dramatic, gut-wrenching sell-off that's followed by an equally stunning and unbelievably fast recovery.
So, let's put some real numbers on this. Just in the first quarter of this year, the tech-heavy NASDAQ index sold off more than 13% from its all-time highs. For a lot of people, this felt like the beginning of something really bad, and you could feel the fear in the air.
But then, and this is the crazy part, just as fast as it fell, it came roaring back. In just 11 trading days, the NASDAQ shot up 15.5%. It erased all those losses and then some. I mean, if you panicked and sold at the bottom, you missed out on one of the most incredible rallies we've seen in a long time.
So what is going on here? What's driving this incredible, almost violent volatility, especially in tech and semiconductors? Well, it's not just random. There are some really powerful forces at play here. Everything from specific, targeted events to massive structural shifts in how our markets even operate.
You can think of it in two ways. On one hand, you have these micro events. Think of them like sudden earthquakes that just shake the market out of nowhere. And on the other hand, you have these huge macro shifts. These are more like the tectonic plates of technology and information that are constantly, slowly reshaping the entire landscape.
Now, check this out. This is a wild example of a micro event in action. At 10:48, a massive, super suspicious trade shorts the oil market. Just minutes later, a market-moving social media post appears, and boom, the price of oil crashes. Hours later, the post is denied, but not before somebody made a huge amount of money. It's just a crazy example of how one single event can trigger massive volatility.
And then you have the macro forces, the bigger picture. News, whether it's real or fake, hits everyone's phone in seconds. But here's the crucial part. It's not people making most of the trades anymore, it's machines. These algorithms, they don't think about nuance or context. They see a data point, an indicator hits a trigger, and they sell. And when one starts, they all follow, creating this massive avalanche of selling or buying.
So this combination of factors creates the perfect storm for emotional investors. Giving in to that fear, trying to time the market, well, it can come at an incredibly high cost to your long-term wealth. I want you to really let this sink in, because this statistic is staggering. Think about it. Over a 30-year period, that's thousands of trading days, missing just 10 of them, the 10 best days, can cut your returns in half. And here's the real kicker. Those best days, they almost always happen right after the absolute worst days.
This chart just drives the point home perfectly. You stay invested the whole time, you get the full power of the market's growth. But you miss just those 10 best days, and poof, your returns are sliced in half. You miss the 40 best days, you would have actually lost money over 3 decades. It's a fool's game to try and jump in and out. It just is.
So if we know timing the market is a trap, what's the answer, right? How do you build a portfolio that can actually handle these storms? Well, it takes a specific kind of strategy, one that embraces the extremes instead of getting all tangled up in the messy middle.
It's called the Barbell Strategy. Picture a barbell. On one side, you load it up with your aggressive, high-growth plays. We're talking assets with massive upside potential. Then, on the other side, you have your ultra-safe assets, things like inflation-protected bonds or even high-yield savings accounts. This whole structure is designed to give you peace of mind during the downturns, while still letting you capture that explosive growth when the market rebounds.
All right, so what does one of those high-growth assets on the barbell actually look like? Let's take a real-world example from the semiconductor space, AMD. It is a perfect case study for the kind of company that fits this part of the strategy.
Now look at the sheer scale of the potential outcomes here. Even in what they call the bear case, this is a scenario where AMD actually underperforms expectations, the stock could still see massive growth. But in the base or bull case, the potential returns are absolutely life-changing. This is exactly the kind of asymmetrical upside you're looking for in a high-growth asset. But, and this is the critical warning that comes with that incredible potential, these kinds of stocks are intensely volatile. You have to have the stomach to watch your investment get cut in half one year, because the reward comes from holding on through that pain to capture the incredible rebound the next year. It is not for everyone, but it is a key part of making the barbell strategy work.
So, how do you develop that kind of stomach? How do you handle that volatility? It really comes down to your mindset. You know, success in this game isn't just about picking the right stocks. It's about adopting the right mindset to hold them for the long term, through all the crazy ups and downs. So here are 3 steps to really shifting your market mindset. First, you have to focus on the future. Today's stock price isn't about today's news. It's about what everyone expects to happen years from now. Second, accept that volatility is part of the deal. These V-shaped moves are a feature, not a bug, of modern markets. And third, you've got to learn to see opportunity in downturns. A huge sell-off can be your chance to buy great companies at a fantastic discount. And that really leaves us with one final question for you to think about. Is your portfolio built with a compass to guide you toward a long-term destination no matter how stormy the weather gets? Or is it built with a parachute, ready to be pulled at the very first sign of trouble? Because the choice you make there will define your entire journey as an investor.
Stay ahead of the market. Follow for stock market strategies, tech investing insights, and long-term wealth tips.